I'm going to pass this along to Paxton Griffin. He's the manager partner for Tioga Capital. He's going to be presenting. I'm going to stop sharing my screen, ask him to project his screen. And Paxton, are you with me?
I'm here with my partner, John Bradner. We're sitting here in Atlanta, Georgia. Hope everybody's doing well. But yeah, no, it's great to be here and introduce you to Tioga Capital and talk about what we're seeing in the market. But yeah, we're Tioga Capital, based in Atlanta, Georgia. Been around for about a decade. An opportunistic real estate and credit investment firm. Really, we're born out of the Great Recession. As some background, I was a bank stock analyst at a regional investment bank, SunTrust Robinson Humphrey, prior to the Great Recession in 2008. And Georgia was the hotbed for bank failures and led the country in bank failures. And so as a result, on the other side of that, there was a lot of opportunity in the distressed real estate acquisition side of things. So started this business coming out of that after restructuring some portfolios with the outsourced third-party workout group, but started investing in distressed real estate in 2011, forming LLCs with friends and family capital, primarily buying NPLs and REO pools from community banks, and that went well. There was a lot of opportunity there, and really where we saw the opportunity at that point in time was being sub-institutional, sub $10 million checks, where the big boys, the big distressed debt funds, it doesn't make sense to get out of bed to come underwrite these deals because they have such large funds, and a 1.4x over 15 months on a $10 million deal. There's a lot of underwriting and work and asset management that goes into it, and that doesn't make sense for a $2 billion fund. So we were picking off these portfolios for several years, and then in the beginning of 2014, we linked up with a Midwestern institutional investor and became a sub-advisor to their hedge funds and private equity funds, exclusive sub-advisor focused on real estate and real estate debt opportunities. And our first investment through this platform was acquiring the portfolio of a defunct hard money lender based in Georgia that had a line of credit issue. So think of it as a short sale where they owed the bank more than what their assets were worth. So we cut a deal with their bank and came in and bought all those assets. It was about 100 loans. They were all commercial real estate loans with a average balance of only $500,000. So you can envision what type of commercial properties are underwater or worth less than $500,000. These were not core assets, but it was a great opportunity. We came in and bought it at a steep discount, and with that, we started a lending platform. And over the past 6 years, we have originated approximately 60 bridge and construction loans as a non-bank or a private lender, and focused on the southeastern footprint, although we have covered some other markets as well. And it's been a great relationship. We've invested several $100 million on behalf or through these funds coming out of the Midwestern group. But then earlier this year decided that we were going to raise a diversified fund. Just in any business, it's better to have a diversified customer base. So we launched a $60 million opportunistic credit and real estate investment fund to continue with the same strategy that we've been executing for 10 years. We're the largest investor in the fund, the management team and family, and we've raised about $42 million and started putting that to work, and we're capping the fund at 60 intentionally, just because we're seeing a lot of attractive opportunities in the $2 to $8 million investment range, and then we have co-investment partners that we can bring in to invest pari passu alongside the fund to still execute on the larger deals. So this is a snapshot of what we've done on the investment side. As you'll see, we've had good performance. It's also been a good time. The last 10 years has been a good time to be a real estate investor, with interest rates going down and a lot of tailwinds helping the assets. But I would also like to say I feel like we've been very diligent and what we've done. This next slide shows a footprint of all the assets that we have invested in, and that's either acquiring the assets, lending on the assets, and then this is just a snapshot of the type of assets. We can get much more granular, but not in 30 minutes. We're not going to get into each of these assets, but it's primarily been commercial real estate, and commercial real estate, the way we've categorized it, also includes multifamily. So of the $209 million of commercial real estate, about approximately half of that has been multifamily. The only thing that is not in our portfolio, that has not been in our portfolio, and that we're not going after, even though there's probably some great opportunity there, is hospitality, because we view that as more of an operating business, and it's just not really our cup of tea. Where we see the opportunity, so there's really 5 things that we're going to talk about here. We're going to talk about community bank balance sheets, private credit markets, the State of the Union, growth in the Sun Belt region, real estate debt investing opportunities, and opportunistic real estate investing opportunities. Starting with the community bank balance sheets, ever since 2008, things have been a little different on the regulatory front for the banks, where they have been much more conservative, but they've also been required to have higher capital ratios. And based on their Tier 1 capital ratios and different concentration limits of different asset classes and risk-weighted assets, they have not necessarily been able to make business decisions that were sensible, but they were more dictated by their regulators. So we get really our primary source of deal flow comes from community banks in the Southeast, and whether that's buying loans, whether that is they have a customer that has a deal that is a transitional asset or short close, or maybe the bank is just over concentrated where there's a lending opportunity and they refer it to us, and that is where the vast majority of our deal flow comes from. And this is just a snapshot of the banks that we are in constant contact with, that for various reasons, these banks, they're sub $5 billion. A lot of times we're dealing with the decision maker, whether it's the CEO or chief credit officer. Whereas if you start working with the big money center banks, you're it's kind of a black box. So these are banks we have relationships with, we've called on, transacted with, or in dialogue with on referrals. So that's where most of our deal flow comes from. Their balance sheets are generally healthy right now, from two points: one, higher capital ratios, and two, anemic growth, or less aggressive growth. So it's hard for a bank to make money in today's environment, and they're focused on a lot of fee income items, and for the most part, they're not lending on residential A&D. They're not lending on land. This is where they got hit the hardest in 2008, and while those are generally riskier loan types, sometimes the baby's thrown out with the bathwater, and there's an opportunity to originate a loan at a 40% loan to value because it's secured by land and it's already entitled, and the risks that typically company land are not as not there, but the bank, just because of its asset type, cannot lend on it. So we like to hang around the banks, and that's where we get a lot of our deal flow. The private credit markets. So the typical debt fund is for the most part, this is generalizing, the typical debt fund is levered at least 1-to-1, and there has been very attractive leverage over the past few years. More and more attractive leverage has been provided by the banks as lines of credit or repo lines. And what a lot of debt funds do to generate higher returns is they will have short-term borrowing, so they'll borrow money on a shorter-term basis than what they're lending because they just assume that they're going to continue renewing their loans. And a lot of these loans were called, and a lot of these groups that were using that to lower their cost of capital and do more business, do more volume. Those guys have they had to hit a pause button, work with those banks, and they've exited the market. We're starting to see some of those guys come back, but there's been a lot more unlevered lending, which is more favorable to us because we generally are not using much leverage. We look at every investment, whether it's equity or debt, we look at it on an unlevered basis, and then if there's attractive leverage available, we'll consider it and use it. There's also a lot more capital that's come into the market over the past few years on the institutional level to offset losses of income on the fixed income side of the portfolio. So you are seeing a lot more money in the market, especially on the upper end. You read about the Blackstones, the Oaktrees, the larger money centers. I've just got a notification. We have a couple questions that I'll go ahead and start answering. One of which is Tioga, a closed-ended fund. Yeah, that's a good question. So our fund, it is a drawdown structure, closed-ended fund. It is there's a 4-year invest, reinvest period that will actually be beginning in March of 2021. That'll be the 1-year anniversary of when we started the fund. So it'll be 3 years going forward. And so we're not charging, you don't have to pay a freight to wait for the deals. We only charge management fees on drawn capital. We've tried to set this up as a very investor-friendly structure. It is a closed-end fund. There will be a 3-year, beginning in March of this coming year, there'll be 3 years of invest, reinvest. So we're recycling capital, and following that period, all the capital is returned as the investments are resolved. In addition, during the invest, reinvest period, all realized income is distributed, and only the principal is recycled. So, for example, if we have a senior loan that has a 12% net yield to maturity to the fund LPs, and that is distributed as it comes in, and then the principal is recycled through the recycling period. And then another question is an example of a community bank. So a great example, I'll talk about a couple transactions of community banks. There's been a lot of consolidation amongst community banks, a lot of mergers and acquisitions, and a good example would be a bank in Thomasville, Georgia, that had 7 branches. So Thomasville is down by Tallahassee, Florida, and the bank had 7 branches and had been around for 50 years, and they were a big player on that part of Georgia. They had offices in Tallahassee, Florida, which is a small, despite being the state capital, it's a small town, a relatively small town, and then Thomasville. And they were merging, and they had about $1 billion asset base, and they were merging with another $1 billion loan, another $1 billion bank. And the combined entity was, after putting the two together, was going to have too much commercial real estate exposure according to the regulatory guidelines. So they needed to shed some loans. So we came in as part of the merger and acquired about 40 performing commercial real estate loans at a significant discount to par. And the reason that we were able to do this is, first of all, we had open dialogue with the CEO of the community bank and a relationship. But the reason that they decided to take this hit was because it was part of a merger and it was viewed as a one-time event. And so they could just shed the assets, and the combined entity would have the appropriate allocation to commercial real estate for the regulatory bodies. So that's a good example of a community bank. But typically, a community bank is sub $5 billion in assets, probably minimum $200 million in assets. Serving they're more likely to serve a developer or a business owner than a large bank that's more, like a SunTrust or a JP Morgan that's more focused on middle market companies. To continue on, State of the Union on the private banks, where we see opportunity, or on the private lenders, is where we see opportunity and have been the most focused, and where our relationships are, and where we're finding deals is in the Southeast. And the census, some of you may have had the census folks knock on your doors over the past year, because they're doing another one right now. But so this is what we're just looking at. It was the most recent one, and I think these trends are probably increasing with everything that's going on, with tax laws and COVID and other things. I think the population is increasing in the Southeast. People are moving to the Southeast, moving to Florida, Georgia, Carolinas, Tennessee, maybe even Alabama. But this has been a trend that's been going on for quite some time. And so in addition to being located here and having the relationships in the Southeast, we also, even if we were just coming here from a different country, we would say this is probably the best place from a real estate perspective to target, given that there is increasing population, increasing jobs, all the fundamentals you look for in real estate. So we like that. It's in our backyard, and we're focused there, and expect to continue to see population growth.
Talk about the credit friendliness.
Yeah, another thing I will talk about that is very important to us and our sourcing and analysis is the judicial system per the state. On the lending side, especially if it's a higher cost debt or buying loans, we always underwrite two scenarios. One is the yield to maturity, which is just cash flow analysis. That there's not a whole lot to that, but then where we spend most of our time before making an investment decision is what does the default scenario look like? In the event of default, what does that look like? And that has to be an attractive proposition, even though that's not something that we're ever looking for or rooting for, but that is an investment scenario that we have to be prepared for, and it needs to be an attractive investment result. So each state is different, the judicial system. So for example, if a loan goes into default in Georgia, it takes about 30 days. It's called a non-judicial foreclosure, and it only takes about 30 days. You have to advertise in the paper for 30 days, and then you can foreclose on the courthouse steps the following week. In Florida, for example, it is a judicial foreclosure process, and so the foreclosure is subject to going in front of a judge, which is very unpredictable and can take well over a year. The same would be said in states like New York or New Jersey, but the states that are non-judicial, so all things equal, where we lean into and look for debt investments, are Georgia, North Carolina, Tennessee, Texas, and states in the Southeast that have a judicial foreclosure system would include Florida and South Carolina, and then Louisiana is its own beast with the Napoleonic law. So it has to be very attractive for us to get involved in something, or to make an investment there, and that's really where we're targeting deals, are in the Southeast and non-judicial states. Our two primary investment strategies are, one that we talked about is the high yield real estate debt, and that includes lending, and that includes buying performing loans. And these are all senior mortgages, typically sub $20 million assets or loans. So they're not quite it's not quite as competitive as the middle market. The max LTV that we would go to on a loan origination is 75%. That differs by asset type, property location, sponsor, strength. So for example, if it's land, we're probably not going to go above 50%. If it's a stabilized multifamily property, maybe we'll go up to 75%. So it just based on our historical performance and where we tend to find deals, or where we're targeting deals. On the lending side, all things equal, we lean into multifamily and growth markets or mid to major markets for two reasons. One, it has been the best performing asset class through multiple cycles, and two, it's the easiest to underwrite. They're the most comps from a rental perspective and from a sales perspective of all asset types. And then I'd say where we see risk after that is we also like residential, so in growth markets, so single family construction, and then after that commercial. Retail is something that there's certainly some good opportunities out there, but we're not doing anything in retail right now. Office, it's more of a wait and see, but a lot of lenders are taking that approach. So there's some low leverage opportunities in office right now, just because other groups are taking a pause. But we're very opportunistic on the debt side, and all things equal favor multifamily. Our other strategy is what I would call opportunistic real estate investing. And this is something we've done for 10 years, and this is the mindset of there's a price for everything. The one asset class on the real estate acquisition side where I would say we're really good at adding value is on land entitlement. And what that would mean, or what that would look like, is we go put and we have partners that do this. We go put a 100-acre tract of land in Metro Atlanta under contract, and it's currently zoned for low-density residential. And we put it under contract at the low-density residential price. And we work with the sellers and have to put up some kind of modest, generally it's a refundable deposit, and we'll go put the property under contract and we'll get it rezoned for a higher and better use. And in the event we get it rezoned for the higher and better use, and we're putting it under contract at the previous zoning or previous entitlement price, we've added a lot of value, and we'll then parcel it off and take it down. In the event we are unsuccessful with our rezoning, we typically will just drop the contract. So that is where we've had our highest returns on the opportunistic real estate side, where we've probably added the most value. But then, we're always looking at multiple deals. So, for example, through our fund, a deal that we have under contract to close in just a few days is a short sale buying a medical office building in Jackson, Mississippi. And this is a deal that was brought to us from some partners that we've worked with before that identified this asset. The owner of the property, unfortunately, passed away. His son inherited the property. He's been managing it for about a year, but he doesn't have any capital for TI or LC. The bank is a small community bank. They realize it's just not a good situation, so they're allowing him to sell the property at a price less than the debt amount. During our due diligence, we had tenant interviews with each tenant. The largest tenant in the building is actually going to invest in the deal, so we're carving out some room in this property because they think it's such a great buy, and they're also extending their lease to make it a more favorable, so adding value before we're even buying it. So that's not something that those kind of deals don't really grow on trees, but with our relatively small fund size, we're able to do those as well, and that's why this fund is targeted to be 60% senior real estate debt and then 40% opportunistic real estate. And those deals typically, they come from different places, but that's just a couple examples of what those look like. But I think we're getting close to being out of time. This is just a screenshot of showing the deals that we've closed in 2020. As you can see, there's a lot of things we look at. Probably about 25% of it we'll actually quote on or spend time on. Maybe it's a soft quote, maybe it's a little bit more than that, and then we'll send a term sheet, and then once it's under term sheet, before we put it under term sheet, we're doing a lot of a significant amount of due diligence, just because we like to have a reputation as a counterparty that performs. So we probably do more due diligence than most before we send out a term sheet, and then 8 deals have closed. So out of 339 that we've looked at, we've only closed on 8 of them. So we're looking at a lot of different types of things, but we're very selective. And just to talk about our team for a moment, we've primarily worked together through this whole period and managed, several $1 billion of distressed assets, starting, in 2010, doing it on behalf of community banks, and then from our own portfolio, about $300 million. So our portfolio's included everything in real estate, including cell towers and, very esoteric assets. So we have pretty good knowledge of a lot of different asset types, primarily in the Southeast, and seeing a lot of interesting opportunities. But if there's any questions, I guess now would be a good time because we only have a few minutes.
So Paxton, there's a gentleman that's saying he wants to know if you do integrate ESG into your underwriting. If so, how?
If what? I'm sorry.
Do you integrate any environmental, social governance standards, criteria into your underwriting process or not?
We don't. We don't. Personally or on the side, we'll do some things or as a company. But our actual investing, there's no philanthropy involved. We're just going for the best risk-adjusted returns. Not looking at anything like that. But as a company, we give back try to give back in the communities where we operate in various ways and through different initiatives.
Got you. Okay. So where do you see the firm 5 years from now?
Yeah, so that's a good question. So where we want to be and where we want to stay is raising a series of relatively smaller funds like this. So focus on putting the money to work in good deals and not getting out over our skis. And then we have, like I referenced earlier, we have some larger co-invest partners. So if we have a $30 million deal, the fund would only invest in $5 or $6 million. We have other partners we can bring in to invest alongside the fund. So we'll continue to grow as a firm and add talent but keep our head down and just try to put up the best performance numbers we can and continue to raise a series of funds that we think we can deploy on a relatively quick basis and put up good numbers.
Okay. Another question that came in was, how has the investment opportunity set changed from when you started in 2011 to where we are currently, at the end of 2020?
That is a good question. So starting in 2011, we were coming out of one of the greatest crises of a lifetime, especially in the commercial real estate side. So asset values were impaired, and balance sheets were battered, and it was really a good time to be buying assets. Where we went from there was a lot of liquidity entered the market. A lot of development occurred. We had a long development cycle, and then another crisis hit. And this time it was more pointed and to where there are winners and losers, or maybe not winners and losers, but there are beneficiaries and then groups that suffered. And so what we're seeing now is we're expecting a lot of distress. Retail, hospitality, certain segments of office, similar to where we were in 2011, and there's always a lag. The crisis hit in 2008. The best buying opportunities were in 2011. So I think on this crisis, it's going to be a similar thing where there's going to be some great buying opportunities on the commercial side, but the world's also changing, so you got to be careful. But those best buying opportunities are probably 6 to 12 months out. And then on the residential side, especially in the Southeast, with all the population trends and the growth, it's a very, very healthy market.
So leading into that last comment that you made, Matt is asking, when looking at the recent growth of the Sun Belt, are you seeing it harder to generate returns as spreads compress with more capital chasing paper in the region?
There certainly is. A place, just for example, let's just talk about Florida. Florida, you go to Miami, you go to Orlando. There's a lot of institutional capital. You go to Northwest Florida, the Panhandle. There's still not institutional capital, but there's growth. And we've actually been, over the last 10 years, we've been active in the Florida Panhandle, and there's some crazy things that happens down there. Some poor, or I don't know if I call them poor, it's like the Wild West of real estate. So it creates opportunities on the flip side of that, and there's still not institutional capital there. So no, I'd say on core assets or on net leases, certainly return expectations should come down just because the rates are so low. But on opportunistic real estate, I don't think a whole lot changed.
So given the fact that you're talking to a lot of these regional banks, how do you see the distress cycle playing out in the various verticals that you're currently in?
Yeah, so commercial, there's going to be distress. Like we said, retail, hospitality. Some banks have already put together pools of hospitality loans and sold them. Others are planning to work them out or see how it goes. I think a lot of that depends on just the recovery, the 2021 recovery, of how deep the distress cycle is. I don't think it's going to be that deep. I don't think it's going to be as deep as it anywhere like it was in 2009, 2010. So these groups that have gone out and raised billions of dollars to buy distressed loan pools may have trouble finding opportunity. But certainly in the sandbox that we're playing in, on the smaller side, there's plenty to go around.
Got you. And so you did mention that some of these transactions already began. Where do you see them pricing as far as discounts? It's
hard to say. There's quite a disconnect right now on the bid ask on certain asset types, such as hospitality, where it's just very difficult to underwrite an asset when you don't know when it's going to be reopened or what that's going to look like. So the pricing, it's across the board. There's loans that are selling that may have some hair on them. Maybe the tenants were under, or the borrower's under a forbearance agreement that's burning off, and the bank just wants to get rid of it, and maybe they're only taking a 5% discount. And they're selling it on DebtX, or it's widely marketed. Whereas maybe if you're working with a bank or a private lender, one-on-one, you might be able to cut a better deal. And that's, so we're really not focused on the widely marketed loan sales. I mean, there's certainly groups doing that and probably do it very well, but that's just not where we're focused.
There's a lot of groups also that just don't have the wherewithal to take a property back and work through the bad bank side of the business, such as smaller, medium-sized family offices. They just want it gone. We worked on a mobile home park portfolio loan sale where operations are trending down, and the group just didn't want to be an owner of multifamily or multi-manufactured housing property, and also they didn't have the skills and the wherewithal to work through a problem loan. So they came to us,
and they had levered their position with their bank, so they needed to, and their bank was not real comfortable with where it was going, so they just needed to pay off their bank, and so it was a pressure situation. So this go around, there's more pressure from private lenders than there are from banks, just because banks have generally been more cautious over the last cycle. But with that being said, there's certainly bad loans on the bank's books as well. The last time it was all the banks, and this time there's a lot of private lenders that are having some liquidity issues.
All right.
Need to sell loans.
There's another question that came in. Are you concerned about inflation and how would your portfolio perform in a hyperinflationary environment?
That is a question. Yeah, I think a lot of people are talking about inflation, and just with as much money that's been flooded into the system, and it's a valid concern, and it's, you know, one of those things that, you know, can just happen very quickly. The asset classes that we think would probably, you know, be hit the hardest in a hyperinflation environment would be triple net leases and core real estate, so very low cap rate assets, where we play primarily being in a senior position on real estate. That's not, you know, that would not, out of all the food groups of real estate, we would probably be, hopefully, if we're doing our job right, would hopefully be one of the least affected, just because our portfolio is not as sensitive. Every asset is sensitive to interest rates, but ours is maybe a little less, being primarily in the senior position.
As well as the fact that our you know, we write paper typically in the
short
24-month term. So
yeah,
short term.
Yeah.
So, you know, if pricing or interest rates drop, or we'll be able to, you know, get out of the deal at that point.
So, when you first started your firm, were you doing these on a deal by deal basis? Is that how you initially started?
We were doing it on a deal by deal basis, and that's really how I would advise. And, you know, I've had people call and say, hey, I'm thinking about starting a real estate investment firm. I think that's the way to do it. You got to start on a deal by deal basis and show the proof of concept. But yeah, we did that in 2011 and 2012, and then in 2013 we had a joint venture with a programmatic joint venture with a large group in New York that was a 90-10. We put in 10% of the money, they put in 90% of the money, and they got to sign up on the deal. But we had some framework for what we were doing, and then in 2014 is when we moved to the fund structure.
That's great. There's a gentleman asking to cover, can you cover your origination costs on a typical deal?
Yeah, so that's a good question. So the way that we look at these deals and the way that we're structured is all the fees we charge a borrower go back to the partnership, and we get paid, you know, just a management fee. So our firm is not taking fees that we charge the borrower. So a lot of times, just to massage the deal to get the best total return, maybe the borrower is more sensitive to interest rates, or maybe they're more sensitive to the fee. So we've actually closed a deal before where we charged a 15% origination fee and a 0% interest rate over 12 months. And we've structured deals where there's you know, no origination fee and a really high interest rate. So it's really across the board, but typically it's, you know, a couple points on the origination and exit.
All right.
So we're solving for an IRR.
I really like this this slide that you have up right now. It's very enlightening. You have to sit through a lot of listening, a lot of reviewing to close 8 deals.
That's right. And it's, you know, it's probably 3 to 5 new deals a day average. Could be more, could be less. It just depends on the day. There's a lot of deals floating around out there. Most of them don't work right off the bat. Some of them are worth digging in. But it's a lot of legwork to find the one that fits.
Yeah, it's really impressive what you guys have done over the last 10 years. And, you know, congratulations on the success, being able to transition from doing deal by deal to a fund structure and having your investors come along with you. That speaks a lot. You know, I have a good feeling about your trajectory, and you know, I appreciate you guys being on today. We look forward to having you back, you know, in 2021. So congratulations on the success, and best of luck with the capital raise.
Well, thank you Michael, thank you for having us, and great being with everybody. And I hope you all have a happy holiday season and enjoy some time with family or friends, or just relaxing and gearing up for next year.
Happy holidays, guys. Happy New Year.
Okay. Take care.
All right. Take care. This concludes the session for the day. We appreciate you all attending. I wanted to thank our sponsors, our members of FLYA. We have an exceptional crew. If you're not a member of FLYA, we encourage you to get involved, and you can do that by talking to myself or somebody on our team. Our next event in the new year is January 21st, Real Estate Direct Lending Private Debt Forum, a little over a month away. If you can imagine that, it's pot 10. We're going to host it the third Thursday of every month. And this space is extremely important to the, not only the U.S. economy, but the global economy. And our experts that we have that are part of our group are bringing amazing educational information. These are thought leaders, and they're providing it to you in the comfort of and safety of your own home, office, wherever you are. Off the real estate topics, we're having an ETF forum on January 28th. ABC is AI, blockchain, or artificial intelligence, blockchain, and cryptocurrency on February 4th. So we have an aggressive agenda for 2021. And that concludes our webcast for the day. Happy holidays, happy New Year, and we look forward to speaking and seeing you all in 2021. God bless.